Problem number 5, page number 37 in the question booklet. A and B are partners in a firm sharing profits and losses in the ratio of 6:4. If you reduce 6:4, it will become 3:2. Their balance sheet as on 31/3/2017 was as follows. Asset side, cash in hand, debtors, less PDD, that is already existing provision for doubtful debts. Stock, buildings, furniture. Liabilities side, creditors, bills payable, reserve fund and capitals. So reserve fund to be shared among the partners. Next, on 1/4/2017, C is admitted into partnership on the following terms. He brings 25,000 rupees as capital. He means the new partner, that is Mr. C. He gets 25,000 as capital and 8,000 rupees towards goodwill for 1/6 share in the future profits. So he's getting 25,000 cash, 8,000 rupees cash to the business, totally 33,000 to the business. Next, depreciate furniture at 10%, appreciate buildings by 20%. So adjustment B has two parts in it, be careful. Next, provision for doubtful debts is no longer required. Word is missing, you have to add it there, is no longer required. So underline the word no longer required. Next, provide rupees 1,000 for repair charges. Next, goodwill is to be withdrawn by the old partners. This is the new adjustment. So the different situation, I can say situation 2 because we have done situation 1 at present. For this, one extra entry than what we have done earlier. So all 4 problems we have done the same. One extra entry here for this adjustment. Remember carefully, goodwill is to be withdrawn by old partners. So whatever goodwill is given by C to A and B, we are crediting to them. Now, not only crediting, they are taking that money out from the business. So C gives 8,000 to the business. In that 8,000, how much belong to A, how much belong to B, we share. Then A and B withdraw the money, one extra entry for that. I will work further. When we work, you'll understand better. Prepare, as usual, revaluation account, partners capital account, and a balance sheet after admission. That is the usual one. So when we get into the working part of it, page number 36, problem number 5, 12 marks problem. I'm ready with the format. I'll go for first revaluation account. Revaluation account here is B, C, and D, only 3. First one is depreciate furniture at 10%. Furniture is 30,000. Reduction in asset. So it is going to be debit 2. Furniture account. $30,000 into 10%, 3,000. Next, appreciate buildings by 20%. That is increase in asset. Credit side. Buildings is 30,000 again. 30,000 into 20%. That comes to 6,000 rupees. Next, this is important for you. As I told, this is the one usually troubles PDD adjustment or provision for doubtful debts adjustment. Provision for doubtful debts no longer required. That means this 2,000 created already there. They don't want that in the new balance sheet. That means the entire 20,000 debtors is good. No doubtful debts are there in the future. So I told earlier also, PDD is like a liability. Liability is 2,000 now. no longer requirements, it is 0. So from 2000, it becomes 0. So when it becomes 0, it is nothing but decrease in liability. So we take it as PDD account. Entire 2000, we take it on the credit side. So it is a gain. When liability is reduced, it is a gain. So 2000 rupees we are cancelling and entered on the credit side of revaluation account. Next, provide 1000 rupees for repair charges. So debit side.
Sir,
Ah,
instead of showing that liability is decreasing, sir, can we show that assets is increasing? Debtors we can increase to 1000.
no, debtors is not increasing. Debtors remaining 20,000 only, it is going to remain in the new balance sheet. The adjustment for PDD, you have to think from PDD point of view only. Don't think from asset point of view. PDD is like a
Okay.
liability. Think as a liability only. That is easier to work. If you think as an asset, it becomes tougher one.
Okay, sir.
So provide for repair charges account to be paid. Repair charges to be paid. That is the meaning of it. So to be paid is a liability. So liability is increasing. So 1000 rupees on the debit side. When you see the total, credit is more. This amount, I'll take it to the debit. So 8000 rupees is the total minus debit side entry, whatever is there. So difference is 4000. To old partners capital accounts, A 4000 into 6 by 10, B 4000 into 4 by 10. Two thousand 400 and 1600. That is, we have got from balance amount. It is nothing but revaluation profit, because credit is more, there's a gain is more, loss is less. So PDD is no longer required, means decrease in liability or a gain. So I have taken in the credit side. Every adjustment you have to be carefully watch and work. Remember. Next, we will move on to the first adjustment. C brings 25,000 as capital. First entry for capital account. Journal entry for capital brought in by new partner. So it is cash account here. Look at the balance sheet. Cash in hand. So cash in hand is 5,000. So cash in hand is nothing but cash account. So cash account debtor to C's capital account. So capital is 25,000. So next, goodwill amount brought in the form of cash by new partner and withdrawn by old partners. This is a new situation. So one more extra entry will be there. So first entry as usual. First entry as usual. Cash account debtor to C's capital account. I'll put it here. Easy for you to mostly recognize and understand. So Goodwill is 8,000 brought in by the new partner. Then C has to give it to others. So C's account debtor to A's account as well as B's account. So C's capital is debit 8,000. Remember, this 8,000 rupees goodwill brought in by the new partner should be divided among the partners in the sacrifice ratio, that is 6:4. So if you divide that, 4,800 and 3,200 is the amount. What do they get? Next, entry number 3. A's capital account debtor B's capital account debtor to cash account. This is the new thing. So A's goodwill is 4,800. He will withdraw. B's goodwill is 3,200 that he will withdraw. So totally cash going out of the business is 8,000 rupees. So this is the new thing that should be understood by you people. For being goodwill amount withdrawn by old partners in full amount they are withdrawing. So you can see here in this capital accounts are credit, here capital accounts are debit. That is how we have to remember. You can see here C's capital account credit, here C's capital account debit, opposite. Here capital accounts of old partners credit, here it is debit. So you have to remember that way and you have to work. Let me come to the partners capital account. As usual, opening balance we have to take first. Opening balance of A and B 40,000 and 30,000. By opening balance brought down, for A and B 40,000 and 30,000. The next is most important. As I told always, we have to find for reserves or general reserve. So we have here reserve fund 4,000. So reserve fund 4,000 to be divided in 6:4 ratio. So name is different here. So it is called reserve fund. So reserve fund account data to partners capital entry will be, so 6:4. So 2,400 and 1,600. Remember, only 4,000 is there. That 4,000 is divided. Next is P&L account. After the second one, no P&L account in the balance sheet. So third entry is not there, or third step is not there. The fourth step is revaluation profit or loss. So revaluation profit is there here. This has to be credited 2,400 and 1,600. So that will be coming on the credit side by revaluation account, revaluation profit. So it is the same as reserve fund. So I have copied that. Next is the first adjustment, that is capital and goodwill brought in. Capital brought in is 25,000. Goodwill brought in is 8,000. Please remember, I have written all the easy way in the brackets. If you remember, that is more than sufficient to work. Next, how much C is giving to the old partners? We have divided the amount 8,000 here, 4,800 and 3,200. That you can remember. Goodwill rupees 8,000 in 6:4 ratio. The same amount here, 4,800 to be debited to C, 3,200 to be debited to C. So here to A's capital account, to B's capital account. So C is giving to A, C is giving to B so much. This is the regular entries what we have done. So new entry, what we have to do now is this one, new one. So A's capital account debtor, B's capital account debtor to cash. So here you can see A's capital account and B's capital account debtor to cash account. I'll write for your reference. Goodwill withdrawn by partners. So this you can remember easily, you will be able to work it on. That is why I am making all the narrations or explanation I am giving there. So easy for you to understand. So 8,000 rupees gone out of the business because withdrawn by the partners. That is, business is giving to the old partners. So that is the last one. So we can go for balancing the accounts. Check the totals. Check the totals properly. Then go for balancing. You have to double check in the exam also. You should not straight away get into urgent working in the exam. You have to be very, very careful. So closing balance I have found by balancing the capital accounts of the partners. Hope you understood the goodwill withdrawn. There's only one entry there, but that will come in the opposite side. Remember, I will work that one when you do the cash account. So cash account, opening balance, we take it from the balance sheet. Opening balance is 5,000. Then C gets in rupees 25,000 as capital plus 8,000 as goodwill. So 33,000 he gets into the business. This is the opposite entry. So this is the cash account, 33,000. This entry by becomes to C's capital. So opposite, cash entries will come to cash account. So we have one more cash entry here, that is in A's capital and B's capital, that comes to opposite side by A's capital account, opposite side, remember 4,800 by B's capital account 3,200. So opposite entry, all cash entries come to opposite side in the cash account. Now we have to go for totaling. So when you balance, you get 30,000. So 38 total, 38 credit, and debit 8,000 is there. So balance leftover is 30,000, that will come in the new balance sheet. So 30,000 as cash comes in the new balance sheet. So when you open new balance sheet, straight away we can write cash in hand 30,000 first only. So this 30,000 comes from cash account. Next we can go for the new balance sheet. Cash is done. Next one is debtors. 20,000 straight away because PDD is no longer required. So PDD we have closed it. Next stock 17,000. Stock no adjustment. Outer column. Buildings 30,000. We have an adjustment. So what is the adjustment for building? Hope you remember. Add appreciation of 20%. You can check your revaluation account. 6,000 you have credited. That is how we have to remember. Next, after building furniture also 30,000. Furniture is depreciated. Depreciation is reduction. Reduction of 10%.
3,000.
3,000 less. That is also there in the revaluation account. So asset side is done. Liabilities side, creditors and bills payable. Creditors 20,000. Bills payable 6,000. So after creditors and bills payable, reserve fund, we are divided among partners. Capitals, we have to take a new value. So A, B, and C. So what are the new capital values? We have to take it from the capital accounts. 44,800 for A, 33,200 for B, and 25,000 for C. Next, all balance sheet items ensured that we have taken properly. After that, if all the items are taken, last verification is your revaluation account. All items taken or not. Buildings is done. PDD not required, have not taken. Furniture is taken. One left, that is provision for repairs, we have not taken. That is provision for repairs is to be paid. So it is liability. So I have entered on the liabilities side. That is a final one. After evaluation check, all items are here in the new balance sheet. We can go for totaling. We can check the totals once. You'll come to know whether you are done right or wrong.